Hi, my name is Diego Mendez. I'm a bankruptcy loan modification real estate lawyer here in Miami, Florida. A lot of people who have been watching my channel are involved in the real estate practice, either through their real estate agents or they're looking to sell their homes. Because remember, all homeowners are real estate investors. That's something that I truly believe. So if you're a homeowner or a real estate agent or a broker or a mortgage broker or different people that have sent me messages, this particular episode of Debt Law Survival Guide for the Desperate Debtor is focused on what happens when you sell your house after forbearance, what are some of the issues that might come up, and also when you're buying a new property after you've been in forbearance and you've sold your property. So before we get into it, I want to talk to you about a couple things. Now, buying and selling your home after forbearance is something that is legal, obviously, and that most people are trying to do. With the high prices of real estate and the low interest rates, people are looking to upgrade their homes or in some ways downgrade and also take some money out for retirement or different things. Now, if you've been in forbearance, there's a couple things you need to understand. We're going to get into that in a second. However, before we do, I need you to please subscribe to my channel and like this video so I keep making these videos as we move forward out of forbearance and into a regular economy. So as I explained, my name is Diego Mendez. I've been doing this kind of law for about 13 years. I've seen a lot of different things. And now that we're coming out of forbearances, a lot of people have questions about what they can do when they come out of forbearance with their property. Now, the biggest thing when you're selling your property after the forbearance is that you need to pay back that forbearance lien. That forbearance lien is something that exists independent of the unpaid principal balance of what you owe. It is added on top of what you owe, so that when you are looking to price your house, you need to take that into account. A lot of people did not realize that when they took the forbearance, that somehow in the end they were going to pay it back. But if you're looking to sell, the time has come. Basically, what you have to do is you have to ask for a payoff, and you have to get a good payoff. The mortgage statement that you get every month is not a good payoff. That will not tell you how much you owe on the house. You need to request a specific payoff. The bank will then calculate how much you owe, including the forbearance. They'll send you a letter that's probably good for 45 days, sometimes 30, that says, this is what you owe if you sold your house within the next 30 days or 45 days. That is a document that you need to request from the bank in order to really determine if you are able to sell your house and make any money on it. Remember, the entire forbearance amount has to be paid. If the forbearance amount includes some principal, which it will usually, then what will happen is they'll reduce the unpaid principal balance by that principal amount that's in the forbearance. But it's usually nominal, and they don't expect a big savings there. So basically, when you get your payoff, at that point is when you should price your house, because you don't really know what you owe without the payoff. A lot of people get excited and say, oh, we need to put it on the market today. Don't do that. If you do that without fully understanding how much you owe, you're gonna lose money. Be sure to get the exact amount so you can work with your real estate agent and get the right price, so that you build in that forbearance amount into the price, since people are so desperate to buy right now that you might be able to get that forbearance basically paid off by the new buyer. The other side of this is the people who are buying. So basically, either you're looking to buy a second property, or you sold your house, you're planning to sell your house, and at the same time, obviously you need someplace to live, so you're gonna go out and buy a new house. So what are some of the issues that people in forbearance will have coming out of forbearance and then trying to buy a new property? The biggest issue is credit. The NonCares Act basically said that if you had a FHA, VA, USDA, Fannie Mae, or Freddie Mac loan, then there was no credit hit for the forbearance. What that meant is that you could take the forbearance, and then for the entire time that you were in forbearance, it would be noted on your credit. There would be a note somewhere on your credit that you were in forbearance. However, it would not affect your FICO score. So the forbearance does show up on your credit, but it doesn't affect your FICO score because there's no late payments. So that shouldn't help. That shouldn't deter you from qualifying for a new mortgage. Obviously, if you have good credit and you've been paying all your other bills. The big question, however, and the thing is that we need to understand about this is that not everybody who qualified for a CARES Act forbearance will be able to buy a home with good credit. What I mean is that midway through 2020, there was a change in the forbearance rules. At the beginning, it said that only people that were current could qualify for mortgage forbearances. So what happened was you couldn't be late in March of 2020. And at that point, if you asked for forbearance, they would have given it to you. If you were late, they would have denied your forbearance. Now, at some point in 2020, the rules changed, and then all of a sudden, you could request a forbearance. Now, the problem with this is that the forbearance rules for the CARES Act only applies for the months that you were in forbearance. If you were late from before, those months are probably still being recorded as late or will be recorded as late. Now, even though they're not foreclosing on you for other reasons, it doesn't mean that they're gonna put all that money in a forbearance and package it up and put it into a big bow at the end. So you might get a forbearance, let's say from June of 2020 until June of 2021, but if you were late before March, those other months, whatever amount of time you were late after that would still be due, and they will probably report it to your credit. So not everybody who has CARES Act will be 100% with perfect credit coming out of forbearance. It's a case-by-case situation, but there are people in that situation. Now, the other group of people who we need to worry about in this situation are anybody who had a non-CARES Act mortgage. Non-CARES Act basically means about 40% of the population have non-government backed mortgages. These people, even though a lot of these banks were good citizens, good corporate citizens during COVID, and they allowed for forbearances, we don't really know if they reported them late or will report them late. So a lot of people are going to have a problem. Even though the bank didn't go after them for those late payments, they do report it either as late or in forbearance, which reporting in forbearance without the CARES Act limitation would be a credit hit, which would damage your credit and basically make it impossible for you to buy a new home, to qualify for a new mortgage. A lot of people who took the forbearance in those non-CARES Act mortgage situations are now faced with a situation where their credit was affected negatively, and there really is not much you can do about that because the federal law does not apply to these mortgages. In those situations, what you need to do is try to come current and pay the bills on time and then rebuild your credit slowly. It might take you a couple years, but at some point in the future, you might be able to come out of the forbearance and then, at some point buy a new home. So bottom line, what you have to understand is if you're selling your property, be sure to get your payoff first, because the mortgage statement is not the payoff. The mortgage statement will probably not show the forbearance amount on it and will not be added. So make sure you get a payoff. It does slow the process down a little bit, but you're better off getting that accurate information. It's only a few days. It doesn't take a long time, but 3 or 4 days. In 3 or 4 days, you should be able to get your payoff. And then at that point is when you and your realtor can sit down and properly price your property with the right expectations of how much money you would get depending on the offer. Now, people who are looking to buy have the issue of the credit. Again, this is a case-by-case situation. Most people aren't going to have a big credit hit, but some people who have non-CARES Act mortgages might have a credit situation that they can't deal with and make it hard for them to buy. Those are the two types of people that we are dealing with now. So be sure to always move forward and try to do your best with these mortgage situations. The forbearances helped a lot of people. They also put some people back. They are not a godsend for everybody, but for a lot of people now they're able to pay back what they owe and buy a new house and move forward with their lives thanks to the increasing price in real estate and the low interest rates that we're in right now. My name is Diego Mendez. Again, I've been doing this type of law for a long time, and I've seen a lot of things. We are moving into a regular economy, but there's still lingering effects from COVID and from all the different situations that people were dealing with after COVID, including these forbearances and what happens after the forbearance. Please subscribe to my channel, Debt Law, Survival Guide for the Desperate Debtor, and like my videos, and you're gonna keep getting these type of videos from me as I focus on different aspects of forbearances and people who are coming out of their forbearance situations and dealing with different credit issues with real estate. Thank you very much, and have a fantastic day.